On the Express this week, if it bends, it's funny. If it breaks, it's not funny. Was the recent market reversal just a rumble or a real rupture? Dan Nathan of Risk Reversal drops in to help us ride this rip. Where Wall Street thinks the big money is headed next year and where it expects this year to end up. The real deal behind Black Friday and what to expect this week. Many rivers to cross, but onward we must press. That's how we ride on the Investopedia Express. Welcome back and welcome aboard. Shout out to all our followers and fans from around the world tuning in. We know you're out there. We know you're out there in India. We know you're out there up in Canada. We know you're over there in Europe listening into the Investopedia Express live every Monday at 10 o'clock a.m. and then on demand on your favorite podcast networks. And welcome back to some choppiness. Last week, no fun for investors. We're bouncing back a little bit if you look at the stock market open on a Monday morning, a little bit in the green across the boards. But last week, not even fun at all. Not keeping too close an eye on the scoreboard this close to Thanksgiving, but the S&P 500 both fell 2% last week, and the NASDAQ fell 2.7%, even after pretty strong earnings from NVIDIA. Everybody was hoping for that. NVIDIA gave a pretty strong forecast, too. Looking ahead, that rally didn't last long. 1,000-point turnaround in the Dow Industrials last Thursday. That is not normal, but hey, neither is a 40% increase since the April lows normal in the stock market. We are not in normal times, but the big sell-off was in some of the biggest stocks. Look at that. Just last week, that was a 5-day chart of some of the biggest movers in the stock market, the biggest stocks in the market, taking it on the chin. Shout out to FinViz. They do great chart work every day. If you want to look at the heat charts in the market or launch that out into a month-long, 6-month chart, FinViz does a nice job with that. But trend lines got broken last week. Things actually felt like they got broken. The S&P 500 was down 6% over a 17-day stretch into its low point of last week. And it actually closed below its 50-day moving average last week for the first time since April 30th, ending the 5th longest uptrend since 1950 at 198 days. Now, I'm not keeping score, but that seems like a pretty big bend in the markets right now. It also fell below its 200-day moving average last week at some point, too. Wake the kids, call the neighbors. Is this normal? No, but we're in kind of extreme times right now. It feels dramatic, and it feels dramatic because some of the biggest hits came to some of the biggest stocks in the market. And as the great and legendary Jimmy Cliff would say, the harder they come, the harder they fall. Rest in power, Jimmy Cliff, passing away yesterday at the age of 81, bringing so much joy to music fans around the world and reggae fans like me. Saw him many times. Shout out to Jimmy Cliff. Many rivers to cross, my friend. But it was the biggest stocks in the market taking the biggest hits, and how the mighty have fallen. We are living in the land of giants, as we've talked about a lot on this show. But look at some of these stocks off their all-time highs as of the end of last week. NVIDIA down 16%, Palantir down 26%. Meta, these stocks are in bear markets. Hey, they rose pretty far, but they are in bear markets. Tesla, normal, volatile stock there, down 20%, and Microsoft down 15%. But as you know, you own these stocks, right? These are the top stocks in our portfolios, according to the Investopedia Sentiment Index that we run every couple of months. You've been telling us this for years, and we know it. Look at my own portfolio. It looks a lot like this, too. Top of the NASDAQ 100, top of the S&P 500, the biggest stocks in the market taking the biggest hits. And not only do we own them, but also institutions say they're the most crowded trade, but they own them too. So long Magnificent Seven, according to the B of A Global Fund Manager survey out last week, the most crowded trade in the market, and long gold too. Makes sense. That's where we've seen the gains, at least with gold this year. But we all know we're a little overweight these stocks, and we all know we're vulnerable to these stocks. And when they get hit, the whole market gets hit. You want another sign of risk in reverse? Look at Bitcoin and anything attached to Bitcoin. It's been a really volatile, bear, choppy market for Bitcoin, down 33% off its all-time high. But look at Ethereum, not the same as Bitcoin, totally different type of coin, but in the family, so to speak. Dogecoin, of course, worth nothing, down 81%. The president's coin not doing so well either. MicroStrategy, now called Strategy, down 69%. It's just a Bitcoin treasury. But when you are just a Bitcoin treasury and Bitcoin falls, well, you're going to fall a little bit faster. So what's happened? We've gone from extreme greed to extreme fear. But you look at what's happening and how quickly it's happened. We've gone from extremely overbought, according to Bespoke Investments, another great chart by them, to extremely oversold. And it's happening so quickly these days. We go from extreme greed to extreme fear. Look at the CNN Business Fear and Greed Index, developed by my buddy Paul LaMonica. We went so quickly from extreme greed to extreme fear, and these cycles are happening so quickly right now, it'll make your head spin. These types of market reversals, these types of emotional movements in the market, some of them headline based, some of them just because we've come too far too fast or fall too far too fast. We react very quickly these days. So is this market reversal a rumble or a rupture? What do we make of this risk reversal? Well, let's bring in the man behind risk reversal. Our buddy Dan Nathan joins us on the drop in. Welcome to the Investopedia Express, my friend.
Caleb, it's great to be here, man. I appreciate you having me on this morning.
Well, you and our buddy Guy Adami, founding Risk Reversal Advisors. I've been on several of your podcasts. You guys put out so much good content, great podcasts, great insights. You have the live events. You're also on the cast of Fast Money and have been for years. And you and I, my friend, have many things in common. We have amazing sisters. Check, right?
Yep.
Shout out to our sisters. We have pretty good hair still at this point in time. Take it. We love markets and we love music. And we love Melissa Lee.
Yeah, we do. I caught that right out of the gate, the Jimmy Cliff. I also saw him back in the day at a reggae Sunsplash in the 90s. He's the man, and a lot of his stuff just covered, right, over the years by all the folks that we like very much. So, yeah, sad news. But you know what? You think about 81, what a heck of a life, man, to be doing what you love for as long as he was doing it.
Yeah. And bringing so much joy to so many people and a humanitarian, just goodness. That guy was just so positive. And my wife and I fell in love to his music, and it's just been important. I saw him at Sunsplash 2 in the 90s in JA. Maybe I saw you there. Maybe we shared a reggae bed, but don't remember it.
Yeah.
Anyway, so good to have you on the show. So I was listening to your great podcast over the weekend, getting ready for our conversation. As you quoted The Wire, the game is the same. It just got more fierce, which I absolutely love. I love that show, and I love that quote. But what do you mean by that? It's just so intense, it seems, in the markets lately.
Yeah, and you just said it before, Caleb. You're like, I own him, you own them, everybody owns them, right? If you own, any S&P 500 or NASDAQ 100 fund, ETF, I mean, you have a lot of exposure to these biggest names. And your point about the harder they come, the harder they fall. I mean, just think about, we had a 5% peak to trough sell-off in the S&P 500, yet many of these names, the biggest ones, were down 10, 15, some 20%. We know that Meta barely saw an uptick from its earnings report, just a few weeks ago. Same thing with Microsoft. And it's interesting because I look at my screens right now and it is a sea of green, right? And the mega cap tech stocks, but NVIDIA is down. And I know that NVIDIA was a big part of the story last week. Microsoft is down. Oracle was down, kind of shot back really quickly. And each week it seems like there's a different Mag 7 name that's taken the baton and just run with it. And Google is that name over the last few weeks. I mean, look at it today, up 6%. This is a nearly $4 trillion market cap company that has literally put the market on its shoulders today, right? And is dragging it higher. And I think that sort of behavior, while it's great when it's working to the upside, it is dangerous on the downside. And you and I have talked about this. I know we have done it on Fast Money over the last few months, that sometimes people just forget that when these stocks go down, they overshoot to the upside, as they might be doing right now, or they did last few weeks, but they overshoot to the downside. And back in 2022, from the 21 highs, we had Meta, we had NVIDIA, we had Tesla, and we had Netflix all sell off 70%. You know this. I mean, it's insane. And people think that can't happen again. And those are the names that you are very well exposed to right now, even if you just own the indices.
Yeah. Well, why do you think that's happening? Just because money's just moving a lot more quickly these days. There's so many different ways to bet or invest or trade on these types of stocks. And we'll get later on into the securitization and financialization of everything. But is that because money's just moving quicker and investors want to follow the trend as fast as they can, wherever they can?
Yeah, I think this is just a theme, and you and I have been in this business long enough, and we've seen a couple of these huge secular sort of moves, like themes in general, but then they end up turning to moves in the markets, and they're not something like, if I had a dollar for every like 3D printing like little theme. Remember that one like 10, 12, 13 years ago, whatever it was, and this was like they all became meme stocks, and they just go the wayside, right? We saw it in cannabis. We saw like like 5 other like major themes where there was like stock market activity, but in the end of the day, they were just really small little pockets within the market. When you look at something like AI, I mean, it is really likely to find itself moving into almost every sector in the market. But right now, the only way to play it is if you sell chips, if you sell memory, if you sell storage, if you sell servers, if you sell compute, right? And then behind that are hundreds of billions of dollars of investment, like investments. So it's hard to A, bet against it, and B, you might as well just ride the train. But as we talk about all the time, and I know you think a lot about risk and risk management, is like, okay, there are ways to not have the idiosyncratic risk, like in Oracle, for instance, you know what I mean? That's been down 40%. You can get exposure through these major indices or some more, specialized sort of ETFs, as long as, again, they're not using, leverage and those, I don't know, you hate those things too, those like inverse or the like 3 times levered, that sort of stuff or whatever. But you can invest in these themes without actually having too much idiosyncratic risk and being stuck with like an Oracle, that sort of thing.
Yeah, there's vulnerability out there for sure, and there's a lot of investors chasing trades, and especially as we get towards the end of the year. We talked to Dan Niles a couple months back, and he's like, "Watch the end of the year," because there's a lot of global fund managers that have been pretty bearish that got bullish, when they should have in April, but they missed out on a lot of upside. So there may be some chasing there, which means more volatility, of course. But what matters now to investors? Because earnings seem to be the thing that mattered most, and that's what we've been riding on really for a lot of this bull market. Plus, Chat GPT coming out 3 years ago and revolutionizing everything. But earnings have been strong. Everybody is kind of focused on the Fed. Does that even matter anymore? I mean, I think we all know the direction of interest rates. Do investors like you care so much about what's going to happen in mid-December because you know what you think is going to happen in 2026?
Well, I think last week was a great example where I think it does matter. I mean, like, I don't know why it does if we're talking about another 25 basis point cut on December 10th, right? And then we don't have a meeting by the FOMC until late January. But think about this. I mean, the market started selling off when the CME Fed Funds Futures started indicating that it was going to be a toss-up, 50-50, right? This was about a week ago, down from like 75%, 80% likelihood just a month ago that you're going to get this quarter point cut, right? And then that moved to 35%. Okay, towards the end of last week. And then on Friday, you had, Fed Governor Williams, here in New York, influential ally to, Fed Chair Powell, say that it's more likely than not, and then the futures rise to about 80%. And that did affect the markets, when you think about even off the lows on Friday. And, so it's easy to say that a 25 basis point cut shouldn't matter the markets. That term, long and variable lags of, monetary policy. What the heck is really a 25 basis point? But I guess it's more signaling, right? And then you think about in a few more meetings, the president is going to be able to install his own Fed chair, right? And there'll be probably some new governors and presidents and all that sort of stuff. And so we might be under a very different, interest rate regime. But all of that comes with the potential for higher inflation. I mean, just think about this. And I know, this is just economics, right? This is just math. If we are going to have lower interest rates, if the president is like behind sending out $2,000 stimulus checks, and it's coming out of the Treasury, which does not have a surplus. Like, let's be clear, right? Lower interest rates, send money out, right, to individuals, to go out and buy things that they probably shouldn't be at a time where we have low supplies of the things that they want to buy. It's all inflationary, right? So if it's all inflationary, at some point, yields or rates should not be going lower. You know what I mean? This is the thing that's kind of crazy. But to your point, stock market doesn't care because lower rates and more money in the system is good for stock prices. It's probably good for earnings.
Yeah, no doubt about it, and that's why even with the whiff of it, you see small caps start to move a little bit, right? You see mid caps start to move a little bit, but when the scent changes the other direction, boy, do they move quickly because investors are so quick to move money these days. Let's talk about volatility and the VIX in particular.
Mhm.
Does it matter, especially in your world, when there's so many other indicators? We got 0 days to even options. We got all these different ways to bet on the market through options and express yourself in very short periods of time. But the VIX now up in the mid 20s or higher, screaming like a toddler in the toy store that just dropped its ice cream. That is getting more attention lately, but it was so quiet for so long. Does it even matter to you?
It's funny. I don't look at the VIX a whole heck of a lot. I mean, I know that, it makes good headlines, whether it's in print or whether it's on TV. They call it the fear index, all that sort of stuff. And I know for the most part, it's not something, all the segments that we do together, it's not something that usually comes up as something that you're using as an indicator. Sometimes it is backward looking, right? We know when we get those spikes, just look at where we kind of topped out. Where is that, 26 or something like that, on Friday morning, and look where we did just, a couple months ago. And those are basically relative bottoms in the sell-offs of the S&P 500, right? So how do you get a move like we had going back to April? Well, you need something that really disconnects investors, right, from what expectations were prior, and that's what the tariff sort of thing did. This move that we just had over the last week, we just talked about how, yeah, the rate picture infused itself a little bit into it, but it really was just a move in momentum, a sentiment shift, right? Like off of those recent highs about Nvidia. I think we can all agree that Nvidia quarter and that guidance was great. There was nothing in that to suggest that the AI trade is over, but it was a sentiment thing. And then you see the VIX spike because people were really complacent into that print, right? And now we have a situation where we got a couple headlines. We got one on the Fed. We also got that Friday afternoon headline where the administration is thinking about, allowing a certain level of an NVIDIA GPU to be sold to China. That took us off the mat. And then all of a sudden you're back here. The VIX is probably going to be a teenager at some point in the not so distant future. So when I think about volatility, I think about it as opposite sides of the coin, the same coin, right? And so, to me, when you get a VIX in the mid 20s and there's nothing really crazy going on like we had in April, I say to myself, this is probably a local sort of low in the stock market.
Yeah, great point. I want to talk about something you brought up on one of your recent shows, the great podcast that you do with Guy about the financialization of the AI build. Right, I think a lot of people are talking about, is there a bubble? And it's not just the asset prices that they're talking about, the stock prices. They're talking about the huge capex spend or pledges to spend this $700 billion over the next couple of years. To build out AI infrastructure and more compute power and more data centers, et cetera. But a lot of it's is been financialized, securitized in ways that could be potentially risky. Explain that, because I thought it was so enlightening, and that's the thing that I think I'm worried about, not the stock prices so much, because the stock prices are, they have this emotion built into them as well.
All right, let's go all the way back to January. It's the first week of this administration, and we saw, a whole host of CEOs, not just tech CEOs, kind of going down into the White House, making an announcement in the Oval Office about these hundreds of billions of dollars that they're going to spend. It didn't even have to be on data centers. A whole host of different folks that made a whole different group of proclamations that were trying to get in the good graces of the administration, right? Well, the most important one was Larry Ellison, who is obviously CEO founder of Oracle, Masa, who is the CEO of SoftBank in Japan, and Sam Altman, who is the CEO of OpenAI. Now, you could say that OpenAI was probably at the time the most important company in the entire world as far as the stock market, as far as just moving money around, whether it was coming into them. They've raised $60 billion so far, and the commitments that they've made externally to spend that $60 billion. So this idea that there was going to be this Stargate, was going to be this huge AI project. It was going to be obviously AI software and development and large language models, but it was also going to be the infrastructure behind it. And, they talked about a $500 billion commitment. All right. Elon Musk, who was very close to the administration at the time, he basically tweeted out almost immediately after that, and he had a lot of reasons for doing that as the CEO of XAI, also saying they don't have the money, to do that build out. All right. So let's flash forward to where we are right now. SoftBank was supposed to fund Stargate to the tune of $30 billion by the end of the year. They've only done $7.5 billion. Okay. Oracle got this huge contract. This is going back to September 10th. Okay. Of basically $300 billion to build out the compute, to build out the data centers that OpenAI would use. Right. And, investors got really excited about it, but then folks were like, they don't have the money, right? So they had to go to the debt markets and they had to raise 20 billion, I think, initially. Now they're doing another 30 billion. Their debt to equity ratio was 500%. The difference between Microsoft Azure, Google Cloud, right, and Amazon AWS, they already had these cloud businesses. They were using their cash flow to fund their expansion, right? But Oracle did not have that same situation. So they had to go to the debt markets, okay? Then even Meta, which doesn't have a cloud business, which has been spending hundreds of billions of dollars to kind of move their AI business towards something called super intelligence with nobody knows what it is and when we're going to happen to be there. They had to fund a data center build in Louisiana through debt. They didn't put, it was off their balance sheet. They put up a couple $2 billion. A company called Blue Owl put up a few $1 billion in equity. They raised cash from KKR to make, this debt, driven sort of operation. And all of a sudden you have Meta, one of the highest market cap companies in the world, taking on a data center project where they only had to put up a few $1 billion in equity, and it's funded by debt. And you're like off their balance sheet. You're like, wait, what's going on here? The biggest, most profitable companies on the planet can't fund these things. And that was the Meta problem. If you guys want to pull up the Meta chart, you see what's happened, right? They're no longer being rewarded for these builds. So the financialization of this, so Blue Owl and KKR, and you're going to see this packaged up, and you're going to see this find its way into private, credit ETFs that are going to be in your 401ks, you know what I mean? Because they're going to be allocated towards it and stuff like that. So that's the point, a long-winded way of saying the financialization of all this, it's no longer just from the cash flow of these companies and these huge cash piles that these companies had, but the cash piles are being depleted. It's weighing on their cash flows. If you can get it off balance sheet, you are, and that's what's going on right now. So sooner or later, if demand slows down for this compute, then you're going to have a problem because these companies are basically going to have used a lot of their cash and they're put pressure on their cash flows, you know what I mean, to build out. And if the demand doesn't materialize, if the technology takes longer to get to AGI and super intelligence, then these companies are going to be having this kind of weight on them like a big yoke.
Yeah. And to requote the greatest show of all time, it's all connected because this will be financialized through private equity offerings that will have just been allowed to be in our 401ks according to some adjustments in the Department of Labor's rulemaking. So it is all connected. And that's why I think people who actually know what's going on, like you, are a little bit concerned about, all right, beyond this and beyond the fact that the government data we're getting now is super old and stale, and we kind of are beyond past that in terms of what we look for. What do you look for? What key market indicators, temperature checks, channel checks does Dan Nathan look for to let you know how the winds are going to blow going forward here?
Yeah, and I think we got to a bunch of this. I mean, I'm kind of old school from the standpoint, the market leadership is really important to me, right? So this whole notion of the market broadening out, and that's a good thing if we see money moving out of, let's say, the top 10 names, which are obviously all these mega cap tech stocks. To me, you can go into financials, you can go into energy, you can go into industrials, but wrap all the weightings of those three sectors, or there's others that, obviously retail has caught a bid just of late. They all don't have enough weighting to move the broader market, right? They can hold things in a little bit. So to me, leadership is really important. If I look at the S&P 500, and even off this bounce from the Friday lows, it's still in a downtrend. It initially stopped at the 50-day moving average, then it got through there, and I heard what you had to say about the 50, and then it stopped on Friday at the 100-day moving average. Well, let's see if it can basically hold at those levels. If not, it's probably on its way to the 200. And the only way it can do that is by losing the leadership, right? So I want to see on days like today whether they can hold the bounce gains. You know what I mean? And the other thing is, I want to see them do it in a way that is somewhat organic, meaning that on Friday, we talked about there were two headlines that saved them. This is 3 Fridays in a row where the stock market looked ugly. And then at some point during the day, there was some sort of headline, you know what I mean, about whether it's a trade deal or whether it was monetary policy or whether it was, NVIDIA being able to sell chips. And nothing really has materialized from those, but it's almost a little bit like that taco trade, right? Like as soon as the stock market starts getting really yippy, as the president used the term about the bond market back in April, as soon as the stock market feels like it's about to kind of really correct, we get some sort of headline. 3 Fridays in a row. Just think about that, Caleb. You know what I mean? They get saved. There's going to be a Friday, and it's probably not going to be this Friday because it's a holiday shortened week. There's going to be a Friday where they don't hold. And that sort of fear is when you're going to see the VIX spike too. And again, I just told you about the VIX. To me, what's only interesting about the VIX is that if it goes to levels that we haven't seen in a long period of time, in a short period of time, right? Then it gets my antennas up, and you better see the leadership now start to firm up in that sort of scenario. So to me, the leadership is the most important thing, and how it acts relative to, let's say, other sectors and what it means for the broad market.
Yeah, follow the leaders for sure. Great advice as always. And this is Baltimore, gentlemen. God will not save you. That's going to be a very, I think, choppy end to the year. Dan Nathan from Risk Reversal Advisors, the great podcast, Market Call that you do with Guy Adami, the great stuff on fast money, and just all the knowledge you put out there for investors like us. I'm so glad we get to talk to you, and I get to be on your show from time to time as well. Thanks so much for being on The Express.
Thanks, Caleb. Anytime, bud.
All right. How good is that, Dan Anthony? We will link to all their great podcasts at Risk Reversal in the show notes, but you should be following them anyway. They're putting out great content all the time in fast money. I think one of the great shows on business TV, anchored by my good friend, Melissa Lee. Dan and Guy have been on there since, I think, the inception, or for many, many years. So check that out. All right. Let's do a little bit of money in motion. You heard us talking about where investors have been placing their bets and where they're putting their money. Well, where does Wall Street think the S&P 500 is going to end 2025? Let's do a little money in motion and check into that. Yeah, Wall Street targets, they matter and they get adjusted throughout the year, but it's always interesting to see where the biggest banks in the world thinks the stock market is going this year. And on the bullish side, Oppenheimer, been there all along, looking at a 7,100 close for the S&P 500 by year, and Wells Fargo as well. On the low side there, BCA Research, 4,500. That's a pretty bearish call, and we're pretty far from that. We're about 20% from that. So that would be a steep decline from here, but we still have 5-ish weeks to go in the year, and we got the shortened holiday week coming our way. But where do global fund managers think the best returns are going to be next year? B of A putting out its global fund manager survey. We'll link to that in the show notes as well. International equities for 2026. It's been international equities this year in 2025 for the stock market. Very rare that international outperforms the U.S., but that has been the case in 2025. And global fund managers, 42% think that will be the case next year, with U.S. equities at 22%. Gold pretty far down there at 8%, and crypto as well, 8%. Corporate bonds at 4%. Very interesting to see where they think returns are going to be in 2026. We'll revisit that as we get closer to the end of the year, but let's get to this week and see what's coming on down the tracks and what to expect this week. It's a holiday shortened week, as you know, with the Thanksgiving holiday up on Thursday, and that means markets are also going to close a little bit early on Friday as well. And we got some news this week, a little bit of earnings, the tail end of earnings, to use a turkey Thanksgiving reference. Today, Agilent and Zoom Communications reporting results. Tuesday, we're getting some delayed government reports coming in with U.S. retail sales for September. The producer price index for September, that feels like summer 3 months ago. Earnings on Tuesday as well from Alibaba, Dell, NetApp, and Neo, among others. Wednesday, initial jobless claims, at least that's going to be more current. That's for as of last week. Initial jobless claims holding in there, despite the fact that we haven't seen a current Labor Department report in a while. And we'll get the release of the Federal Reserve's Beige Book from its last series of meetings. That Beige Book is actually red. I've seen it in person, by the way. Earnings from John Deere and Lee Auto. And then Thursday, that Thanksgiving holiday, take a break, a little tryptophan pause, looking forward to spending some time with family, looking forward to being grateful, looking forward to sharing a great meal with the people I love. And I hope you get to do the same. And on Friday, stock markets close at 1, the bond market closes at 2. I don't know why they do that. Why don't they just close at the same time? But it's also the beginning of the Black Friday holiday, which we're going to talk about in just a second. But big expectations for retailers this year. The National Retail Federation saying we're going to spend over $1 trillion in holiday shopping this year. That's over $890 per person. I don't think I'm going to spend that much, but maybe between taking the family out for dinner and plane tickets if I have to buy them. But in terms of buying gifts, I don't know. That seems like a lot of money, but that's about a 3 to 4% increase from last year. And even though consumers feel super tight about the economy and consumer confidence is very low, one thing we're very good at is getting past that and doing shopping, especially around holiday shopping season. So let's get to our indicator of the week, because it's got everything to do with Black Friday, which has a lot of connotations in the stock market, retail, consumer, buy everything world. It's really about the busiest shopping day of the year, but it's really not that anymore. It's the Turkey 12. It's the 12 days around Thanksgiving. But I'm going to take you back in history. Black Friday, September 24th, 1869. That was a stock market crash caused by rampant speculation by Jay Gould there on the left and James Fisk. They tried to corner the gold market by buying up bullion, enlisting President Ulysses S. Grant, brother-in-law, Abel Corbin, to persuade the president to limit gold availability. Yeah, they tried to constrain supply while they tried to corner the market. Their manipulation attempt failed when Grant learned of it and ordered the U.S. Treasury to sell $4 million worth of gold. A little family intrigue on Black Friday, 1869. On that Friday, the price of gold plummeted from $160 to $130 per ounce, causing the gold market to collapse and the stock market to drop over 20% the following week, which ruined many investors. And as we know, back in the day, a lot of people were pretty deep in the stock market. Now, cut to today, cut to the 1950s, I should say, not quite today, 70 odd years ago. This was the term Black Friday. That was a shopping day that originated in the 1960s with the Philadelphia police. Allegedly, they used it to describe the chaos, the traffic jams, the accidents, and the shoplifting caused by suburban tourists beginning holiday shopping and attending the Army-Navy football game at the time. City merchants tried to rename the holiday to Big Friday. So this term Black Friday that you're going to hear constantly and you see across every advertisement coming your way really has a lot of deep connotations. Some of them not so nice going into the past, but just know what it means. And you don't have to shop on Black Friday. That's just when they want you to do a lot of the shopping. Do some giving this Thanksgiving and make sure you're giving the gift of gratitude, reciprocity, generosity, all undefeated. And this Thanksgiving, I am grateful to you all, Investopedia listeners, watchers, viewers, readers, all the people that have been coming to Investopedia for 26 plus years now, but especially those who spend time with us on the Investopedia Express. Grateful for you, grateful for the production team at Launch Live doing some great work on this show and a bunch of other shows. Make sure you're following what they're up to as well. Grateful for family, grateful for my colleagues here at Investopedia and the People Inc., and just grateful that we have this time together. So on this Thanksgiving, I hope you have some gratitude in your life, and we'll talk again a little further on down the line.